So in this what if question, let's assume that at the wine store, instead of being an unlisted entity, it is a listed entity, and that the AAA audit manager and the audit team own shares in the wine store. Now I have a question for you, and it's a multiple choice question. Would this be a threat to independence? So you have 4 options there. No, as it is the audit manager and not the audit partner who owns the shares. Yes, it's a self-interest threat. Yes, it's a confidentiality threat. Yes, it's an advocacy threat. Which one of those is correct? Okay, the majority have had a go. I'll give you a few more seconds. Terrific. Let's broadcast these results. So the answer, well, let's say what the most popular answer was is yes, it's a self-interest threat. And for those of you that answered that, you are correct. This is a threat to independence, and it is a self-interest threat. So the audit manager has a personal vested interest in the wine store. The audit manager would want the wine store result to be as high as possible to obtain the highest return possible. So in this instance, that would define an independence threat, and specifically based on the definitions, it would be a self-interest threat. Now, just as a point to note for those of you that did click on confidentiality threat, there is no such threat known as a confidentiality threat. Having said that, confidentiality is one of the fundamental principles in our ethical requirements, and yeah, you should be aware of that as well. Terrific. Let's go and test your understanding a little bit further on this topic. Another what if for you. Let's assume on this occasion that a self-interest threat exists as a result of the shares owned by the AAA audit manager in the wine store. Can audit independence be achieved? You have 4 options, and there is one correct answer for you to select. Okay, there's 50% of you that haven't had a go at answering this question yet. So let's broadcast the results. 40% of you said that yes, it can be achieved if the AAA audit manager sells their shares. That is absolutely correct. From the options provided here, this would be possible if the audit manager sold their shares in the wine store. Well done. And for those of you that have selected the other options, it is imperative that you do look at section 290 of the IESBA code and make sure that you're across when and how and under which circumstances safeguards are applicable, and that in this instance that would be an option. Terrific. Here's another what if question for you guys. So what if this was the first year audit for AAA? Let's assume that the wine store was previously audited by another auditor, and AAA has started the audit this year. Now, the question to you is what would AAA be checking with respect to the prior year audit? This is a multi-choice, but you have more opportunity to answer more than one is correct here. So would AAA be checking for the independence of the previous auditor, the competence of the previous auditor, reviewing the previous work papers, ensuring compliance with audit standards, and check for material matters which may impact the current year? Which one or ones are correct? Okay, let's broadcast these results. So the most popular answer is check for material matters which may impact the current year, and I would definitely say that that is one of the ones that I would say yes to. But I would also say yes to, if you said independence of the previous auditor, I'd also say yes to the competence of the previous auditor. I'd say yes to the review of previous work papers, and I'd also say yes to ensure compliance with audit standards. So All of these options would be appropriate for AAA to consider as part of a first-year audit where there was a previous auditor. And for those of you that didn't select all of those 5, I suggest we take a look at ISA 510 to brush up on your knowledge in that respect. All right, guys, let me take you now to check on your understanding of risk assessment. I'm going to provide you with a poll now, a multiple choice poll, and the question is, when we assess the risk of material misstatement, what do we consider? Now, there's only one correct answer here. Is it audit risk, inherent risk and control risk, inherent risk, control risk and detection risk, audit risk and detection risk? I'll give you a moment to select the correct answer. Okay, let's broadcast these results. So the majority have suggested that inherent risk and control risk would be what we would need to look at when we assess the risk of material misstatement. That answer is correct. Well done. Remember, based on the audit risk model, we assess the risk of material misstatement by considering inherent risks, which can also be based on the consideration of business risks, that is, the risk that the entity won't achieve its objectives of profitability, growth, and survival. And we also consider control risks, which is based on the internal controls in the entity and whether they detect and prevent misstatements from occurring. So your risk of material misstatement is to look at both the inherent risk and the control risk. For those of you that selected inherent risk, control risk, and detection risk, that would be answering a very different question, which is what are the factors which would impact audit risk? Okay, so I suggest you make sure you go back to your audit risk model, make sure you understand that the 2 elements that do impact risk of material misstatement are inherent risk and control risk. Let's expand a little more on this concept to check your understanding a little further. So, if an entity was operating in a complex business and industry, what would this impact? Inherent risk, control risk, audit risk, or none of the above? This is a multiple choice question for you. There's one correct answer. Okay, terrific. Let's broadcast the results. They always say the majority wins. I'm not sure now. Let me have a look. So the majority say that inherent risk would be the correct response, and I agree with that. So if we had a complex business and industry, this would be an inherent risk to the business. So thinking about what the word inherent means, and I can understand those of you that may have selected other options, but we don't have any more details outside of an entity operating in a complex business and industry. So it's a hypothetical question. They're the only factors we have in play here. So due to the nature of a complex business environment and industry, this can result in a material misstatement across the financial statements, and hence why we would identify this as an inherent risk. Terrific. If you recall from the background information, it stated that there have been a history of stocktake errors. I'm going to change a little bit the assumption here. Let's assume that this was not the case for the wine store. That is, what if there wasn't a history of stocktake errors at the wine store? How would this information impact the risk of material misstatement? Once again, we'll provide you with a multiple choice poll, and there is one correct answer. So we're now assuming there's no history of stocktake errors, and I'd like to know whether that information would impact, if and how, the risk of material misstatement. Excellent. Okay, let's broadcast the results. The majority are saying that the impact would be a decrease in control risk and therefore a decrease in the risk of material misstatement, which I definitely agree with. Well done. Based on the history of stocktake errors at the wine store, based on the background information, this would indicate that systems have not been improved or controls put in place to rectify this problem. In the original instance, that would have increased control risk and therefore increased risk of material misstatement. What we've done now in this what if question is basically assumed that the controls are working and operating well, in the sense that there's no history of stocktake errors. In this instance, therefore, control risk would decrease and the risk of material misstatement would decrease accordingly. Well done. Remembering that we always have a link between control risk, inherent risk, to our risk of material misstatement in the same way. Another question. The background information stated that there is a potential for growth in overseas sales. So, based on this, with the potential for growth in overseas sales at the wine store, this may result in foreign currency transactions. Would this increased risk of material misstatement from foreign currency transactions be a risk at the financial statement level or at the assertion level? Give you an opportunity to select the correct response. There is one correct response. Okay, terrific. Let's broadcast the results here. Now, the majority have suggested that this would impact both the financial statement level and the assertion level risks. If we had a look at what the issue is here, it's with respect to foreign currency transactions with respect to sales. So specifically, we'll have an issue around foreign currency transactions with sales. If we can be specific enough to see where those accounts are going to be actually impacted, it would take away from a financial statement level risk because it is specific to sales and FX accounts here. So the answer would be the assertion level. So well done to those of you that have selected the assertion level. Remember, when it comes to financial statement level risks, it impacts across the financial statements. Hopefully I didn't give you enough information to check your understanding into poll 9. Let's see how you go now. So from the background information, it states that the wine industry is experiencing increased competition and the oversupply of local wines is reducing prices for wine. Would this be a risk at the financial statement or the assertion level? Or neither? Or both? Okay, guys, let's broadcast the results. So in this question, the majority answered that it's a financial statement level risk. I would definitely agree with that, and I'd also say that well done. You obviously were listening to what we were chatting about before. With this experience that we're proposing, and we've got increased competition and oversupply of local wines, this would be placing a lot of pressure on management. So fundamentally, they would want to have there'd be pressure for them to increase profit. Now, when you think about how do we increase profit, well, that can happen via many different forums in the financial statements, whether it be increasing sales, decreasing expenses. So there's an impact across the financial statements, not specific, that you could specifically attach to a specific account here. So well done for those of you that got the financial statement level risk, and for those of you that need to brush up on that concept, Unit 3 is the place to go. Well, that was great, and a great check-in on your understanding on the first element and concepts that we covered in application video 1. So this is a little bit of a different question. It's not a multiple choice. There's only one or right or wrong answer. It's a yes or no emoji. So the potential of fraud will be reflected in the audit approach adopted. Having identified the risk of fraud in purchases, would you obtain an understanding of controls in the purchasing function? Tick yes if you believe that you should. Cross no if you believe you shouldn't. Okay, guys, the majority, and I don't have a percentage to give you, I'd have to sit there and calculate it, and I don't have time for that, say yes. And I agree with that tick, so well done. So we've asked whether you would obtain an understanding, that is a critical part of this question, whether you'd obtain an understanding of controls. And yes, you would understand the controls, and in particular note the deficiency which would allow fraud to occur and remain undetected. So if we go back to the purchasing function, you would understand the control environment in respect to purchases. You'd inquire of management about the purchasing process, including their controls, and then you would determine your approach, whether it be a combined approach, which means test of controls as well as some substantive procedures, or purely a substantive audit approach. So there are a couple of things that you need to be aware of. For those of you that put a cross there is still the requirement to understand the controls in the purchasing function. Even though you believe that they're not operating effectively, you need to understand them to be able to make that call that they aren't operating effectively. Okay. Let's go to a what if. What if the control environment was considered to be ineffective at the wine store? The fact said it was an effective control environment, but I'm going to switch that around now. Could we still continue with a combined approach? The answer is no. So if you put a cross there, well done. If you put a tick, remember if you assess the control environment as ineffective, it would be a waste of time testing controls since they're either designed ineffectively or you don't expect them to operate effectively. In either case, testing controls won't provide you with the audit evidence you need. So instead, what you would need to do is change your audit approach to rely on 100% of substantive audit procedures. Now remember, if you do find control deficiencies as part of your control testing, these must be communicated to those charged with governance, and if they are significant deficiencies, you need to do that in accordance with ISA 265. Another what-if question for you guys. Following the media allegations that the wine store have not been paying their junior staff at the appropriate penalty rates, the New South Wales Office of State Revenue has opened an investigation into the wine store's payroll tax returns for the prior year. Does this affect our decision to test controls over payroll? If you believe it does, tick yes. Otherwise, a cross if you don't believe it impacts our decision to test controls. Okay, the majority here is, from what I can see on the screen, we've got a lot more ticks than we have crosses, and the answer is no, once again. So for those of you that got the cross, well done. Remember that this is just one data point. While it might indicate that there is something wrong with the payroll process, particularly around how payroll tax is calculated, you don't have enough information yet to conclude that the controls in the entire payroll process are ineffective. There could be some potential implications down the road in the event that the wine store is assessed with additional payroll tax liabilities, but right now it's too early to tell. Note that we would need to make sure we keep an eye on the payroll tax investigation and any further developments. That's terrific, guys. That's the end of my what-if questions, but I do have some exam tips and techniques I'd like you to make sure of going forward. So let's wrap up today with some of these techniques and tips. Always use the background information. Working through the application video 1 should have shown you how to use the information provided in the background. It's there for a reason. This should have helped you understand why it's been included and how to reflect it in your actual response. Reflect on what made the question easier to answer. What actually helped you understand? Did you need the audit risk model diagram to remind you of the risk of material misstatement and the impact on audit procedures? Think about what triggers you want to take with you in the exam, and if you haven't already started to do so, put them in your critical file to take into the exam. As we saw in application video 1, task words provide you guidance as to what to include in the answer and to what depth. Remember, they can be found in the exam tips and techniques document in the exam section on the module learning page. And answer the question you've been asked. Did you identify and explain, or did you just identify? You don't want to be losing marks in the exam if you have not answered all parts of the question.